Welcome everyone and thank you for watching. Today we will talk about savvy IRA planning for baby boomers. A lot of people have a plan for accumulating money for retirement, but far too often that's where the planning stops. That's not good enough. The reality is that a sound distribution strategy, in other words, a plan for taking money out of your retirement accounts, is just as important, if not more so. When it comes to your IRAs and other retirement accounts, you probably have a lot of questions like, how much are my withdrawals taxed? When do I need to begin taking withdrawals? How much will I have to take? What happens to my IRA when I die? And perhaps most importantly, how can I minimize my taxes so I can spend more of my hard-earned money? We'll discuss each of those questions today, but before we do, let me tell you a little bit about myself and my company. My name is Chris Foster, and I am a financial advisor and partner at Full Cup Financial with John Keeble. John has worked in the financial planning industry for over 30 years and is a certified financial planner. He lives in Athens, Georgia, and is married to his college sweetheart, Beth. John moved from Atlanta to Athens in 2016, where he and Beth love riding their horses and playing music when John is away from the office. John has 2 children and 4 grandchildren. I have been in the financial planning industry since 2015 and am an investment advisor representative and registered rep. I live in Homer, Georgia, about 35 minutes north of Athens, and am married to my high school sweetheart, Shay. Together, we have 2 children, Charlie, who is 4, and Caroline, who is 1. John and I have been business partners since 2019, and we designed our webinar series to empower and educate, equipping individuals with the tools and insights needed to navigate the complexities of their financials. Our mission is rooted in the belief that each individual, family, and organization can cultivate good stewardship through proactive engagement with their financials. We recognize that everyone has a financial plan, whether consciously acknowledged or not. However, the distinction lies in its proactive nature. Our aim is to guide you in crafting a proactive plan tailored to your unique goals, ensuring meaningful outcomes for you and your loved ones. Throughout these webinars, we will explore key areas of financial management, from comprehensive planning to strategic investment approaches and risk management strategies. Our goal is to provide you with some knowledge and resources necessary to make informed decisions and navigate your financials with confidence. So now that you know a little bit about me and Full Cup Financial, let's talk about some savvy IRA planning strategies. Years ago, life was simpler in many ways, and retirement was really no different. Many people went to work, and then when they retired, they collected a pension and Social Security benefits. There wasn't as much needed in the way of planning, and people weren't all that concerned about running out of money, since both their pensions and their Social Security benefits were generally guaranteed. For most people, that, along with whatever else they had managed to save along the way, was enough. Today, though, things are different. Companies and other organizations have abandoned pensions in mass numbers and instead have turned to 401ks and similar plans, shifting many of the risks they once shouldered onto the backs of employees and their families. Retirees are now responsible for making more of the critical decisions that will determine how successful they are in retirement. And that includes keeping up with changes to the law. That happen all the time. For instance, the law known as Secure Act 2.0 made nearly 100 changes to the rules for retirement accounts, some of which we'll talk about today. The bottom line to all of this, though, is that today, more than ever, when it comes to your retirement, you're on your own. On top of that, your retirement savings may have to last you a lot longer than you think. According to a 2011 Society of Actuaries report, over 40% of retirees underestimate their life expectancy by 5 years or more. Take a look at this chart to see what I mean. If you're a man and you're 65, you have a pretty good chance of living to at least 85. If you're a woman and you're 65, you have a better chance of living past 85 than you do dying before it. And if you're married and both you and your spouse are 65, then there's a strong chance that at least one of you will live to be 90. In fact, there's about a 33% chance that at least one of you will live to be 95. That means your retirement savings could easily have to last you 20, 25, 30 years or even longer. That's probably much longer than a lot of you have considered. Put all of this together and it makes having a plan all that much more important. With that in mind, one of the best things you can do as you approach retirement, if you're not already there, is to beef up your retirement savings by contributing as much as possible to tax-favored retirement accounts. Although contributing at younger ages is more powerful, because it gives your contributions more time to compound. You may have been unable to save as much as you wanted to because you were bogged down by mortgage payments, were saving for a child's education, or had other expenses associated with raising a family. Chances are you no longer have those expenses, or they'll be ending soon. As a result, you may finally have discretionary income that can be used to fund your retirement accounts. So just how much can you contribute? Well, that depends on the type of retirement account, as well as a number of other factors. Let's begin with traditional IRAs. A traditional IRA, or individual retirement account, is a personal retirement account that offers certain tax benefits. Contributions may be tax deductible, and while your money is inside the IRA, it grows tax deferred. Ultimately, when you take money out of your IRA, the amount you take out is generally added to your income. We'll talk about that more later. In 2024, the maximum you can contribute to a traditional IRA is $7,000. If you're 50 or older by the end of the year, though, like most of you, then you're allowed to make an additional $1,000 catch-up contribution, making the maximum you can contribute to an IRA for 2024 is $8,000. You can't always make a traditional IRA contribution, though. For instance, to make a traditional IRA contribution, you must have what the tax code refers to as compensation. For most people, compensation is earned income, but it also includes a number of other types of income, such as taxable alimony. It does not, however, include things like interest, dividends, capital gains, Social Security benefits, or unemployment compensation. So most of the time, if neither you nor your spouse work, you won't be able to make a traditional IRA contribution. In the past, age was also a barrier that prevented some people from making traditional IRA contributions. But that hasn't been the case since 2019. And traditional IRA contributions are deductible unless you or your spouse are active participants in an employee-sponsored retirement plan, and your income exceeds an applicable threshold amount. Those limits depend on your filing status and who is contributing to an employer-sponsored plan. Many of you probably know that there is another type of IRA called a Roth IRA. Roth IRAs are similar to traditional IRAs in many ways, but there are also some key differences. One of those differences is that you don't get a tax deduction when you make a Roth IRA contribution. Once your money is in a Roth IRA, it grows tax deferred like it does in a traditional IRA. The big benefit of the Roth IRA, though, and another key difference between it and a traditional IRA, is that Roth IRA distributions can be tax-free in retirement. If you've had any Roth IRA for more than 5 years and you're over 59 and a half, then all withdrawals from any of your Roth IRAs will be tax and penalty free as part of what's known as a qualified distribution. Even if you need to take a withdrawal sooner, you can always take out your Roth IRA contributions tax and penalty free. Some of the same contribution rules that apply to traditional IRA contributions also apply to Roth IRA contributions. For instance, the same $7,000 contribution limit applies. Similarly, if you're 50 or older by the end of the year, the contribution limit is increased to $8,000, thanks to the $1,000 catch-up contribution. Roth IRA contributions are also subject to the same compensation rules as traditional IRA contributions. If you have sufficient compensation, then the only thing that could prevent you from making a Roth IRA contribution is having too much income. You can see the income limits up here on the screen. Note that if you're a single filer, as long as your income is under $161,000, you can make a full Roth IRA contribution. Similarly, if you're married and file a joint return, then as long as your income is under $240,000, you too can make a full Roth IRA contribution. While some baby boomer couples retire at the same time, oftentimes one spouse retires before the other. In such cases, you may be able to take advantage of spousal IRA and/or Roth IRA contributions. These are special contributions that allow a spouse with compensation to make a contribution to the traditional IRA or Roth IRA of a non-working spouse. In essence, the non-working spouse can use the working spouse's compensation as their own. You might be asking yourself, can an $8,000 contribution really make a difference when it comes to my retirement? The answer is absolutely. Here's a quick example. Suppose you're 55 years old now and you plan to retire in 10 years at 65. The kids have flown the coop and you finally have a chance to focus on saving for your retirement, so you make a full $8,000 Roth IRA contribution annually until you retire. If, say, you earn 6% per year, Then by the time you retire in 10 years, you'd have more than $100,000. But remember, you may need to plan on living until 90, 95, or longer. So let's say that you leave the account alone and it continues to earn 6% per year. By the time you reach 85, even if you never put another dollar in after the first 10 years, you'd more than $350,000. Plus, since you made your contributions to a Roth IRA, that entire amount would be tax-free. Still think just $8,000 a year can't make a difference? And just think, if you're married and you were able to make that $8,000 contribution to both your Roth IRA and your spouse's Roth IRA, you'd have twice as much, tax-free. If you're still working and you have access to one or more plans through your current employer, you might be able to do even better. While the limits on contributions can vary depending on the type of plan your employer offers, you can generally contribute more to your company plan than you can to an IRA. For example, in 2024, you can contribute up to $23,000 of your salary into a 401k, 403b, or similar plan. If you're 50 or older by the end of the year, then you can contribute an additional $7,500 as a catch-up contribution, bringing your total potential plan contribution to $30,500. Depending on your plan's provisions, you may also be eligible to receive employer contributions, such as a company match or profit-sharing contribution. As you can imagine, putting this type of money away for even just a few years can have a marked impact on your retirement savings. Plus, provided you meet the requirements we just discussed, you can make a contribution to your IRA or Roth IRA on top of your company plan contribution. Of course, at some point, you're likely to retire, and when you do, you'll be faced with one of your first major retirement decisions: what to do with the money you've accumulated in your employer-sponsored retirement plan. In many cases, people choose to roll their funds over to a traditional IRA or Roth IRA because they tend to offer greater control over one's retirement funds. They are not the only options, though, and such rollovers are not always the best move. Believe it or not, you may have as many as 6 different options for your employer-sponsored retirement plan funds when you leave work. You can see them here on the screen. Each of these potential alternatives offers unique benefits and drawbacks, so it's usually a good idea to discuss your options with a knowledgeable professional so that you can make the savvy decision that's right for you and your family. All right, getting money into your retirement accounts is only the first half of the story. Coming up with an efficient way of taking those funds out and avoiding costly mistakes is the other half. This is far easier said than done, particularly when it comes to your traditional IRAs, 401ks, 403bs, and other pre-tax retirement accounts. In general, withdrawals from these accounts are taxed at ordinary income rates, just like interest. Your withdrawals are added to your income and taxed at whatever tax bracket you happen to find yourself in. If your overall income is relatively low, you might have a low tax rate for your withdrawal. On the other hand, if your overall income is higher, your tax rate will be higher and more of your IRA withdrawal will end up in Uncle Sam's hands. Here's a quick look at the tax brackets for single and joint filers for 2024. All right, getting money into your retirement accounts is only the first half of the story. Coming up with an efficient way of taking those funds out and avoiding costly mistakes is the other half. This is far easier said than done, particularly when it comes to your traditional IRAs, 401ks, 403bs, and other pre-tax retirement accounts. In general, withdrawals from these accounts are taxed at ordinary income rates, just like interest. Your withdrawals are added to your income and taxed at whatever tax bracket you happen to find yourself in. If your overall income is relatively low, you might have a low tax rate for your withdrawal. On the other hand, if your overall income is higher, your tax rate will be higher, and more of your IRA withdrawal will end up in Uncle Sam's hands. Here's a quick look at the tax brackets for single and joint filers for 2024. To make matters even worse, your IRA withdrawals can cost you in a lot more ways than just adding to your income. They can also cause you to be phased out of itemized deductions, personal exemptions, and various tax credits. They can increase your exposure to the 3.8% surtax on investment income. If you take an IRA withdrawal, you might have to include more of your Social Security benefits in income, and your Medicare Part B premiums can increase. And that's just the beginning. If you want to try and avoid these issues, then you need a plan. One way to minimize the tax impact of retirement account withdrawals is to avoid taking withdrawals altogether. That allows your retirement money to grow tax-deferred, and keeps that nasty taxable income off your tax return for as long as possible. You can't put off taking withdrawals forever, though. Once you reach a certain age, the law requires that you begin to take what are known as required minimum distributions, or RMDs for short, from your traditional IRA. The same rules generally apply to employer-sponsored retirement plans, like 401ks too. RMDs are simply the bare minimum you are required to take from your retirement account each year to satisfy the tax code's rules. The specific age when you must begin taking RMDs depends on when you were born. If you were 72 or older as of the end of 2022, you should already be taking RMDs for your IRAs. For those of you who were still younger than 72 at the end of 2022, you'll have to start taking RMDs when you turn 73 or 75, depending on when you were born. As you can see here on the bottom of the screen, for those of you born from 1951 through 1959, you'll start RMDs at age 73, and for those of you born in 1960 or later, you'll start taking RMDs when you reach 75, unless Congress changes the rules again between now and then. A final thought before we move on. Remember that you can always take more, but if you fail to at least take the minimum amount, the IRS can actually hit you with a 25%, that's 50% penalty, for any amount that you should have taken but didn't. To calculate your RMD, you need to know two things: your prior year-end balance and your life expectancy factor. Getting your prior year-end balance is usually pretty simple. In most cases, you can look at your December or fourth quarter statement and use the ending balance. Then you use your age to look up your life expectancy factor on a special table provided by the IRS and divide your prior year-end balance by that factor. For example, suppose you're calculating your 2024 RMD. The first thing you need is your prior year-end balance. So let's imagine that your December 31st, 2023 IRA balance was $200,000. That's part one. Next, you've got to figure out your life expectancy factor. Most IRA owners use what's called the Uniform Lifetime Table to calculate their RMDs. If you look on the screen, I've given you some of the life expectancy factors. So let's imagine that you turn 75 this year. Now we simply go to the table and look up the factor for a 75-year-old. As you can see, the factor for a 75-year-old is 24.6. So to determine your RMD in this hypothetical example, we divide $200,000 by 24.6 and get $8,130.08. Then each successive year, you do the same thing. Take your prior year-end balance and divide it by your new life expectancy factor. Not too bad, right? Of course, most people don't think about things in terms of factors or life expectancies. So here's a chart I think you'll find helpful. It shows the approximate percentage you need to take out of your IRA from 73 to 90 in order to steer clear of the 50% penalty. If you look, you'll see that each year the percentage you need to take out increases. That doesn't necessarily mean you need to take out more money each year than the last, though, as that also depends on how much your IRA gains or loses from year to year. RMDs can actually get much more complicated, and as we've already discussed, the penalties for making a mistake can be pretty severe. With that in mind, let me tell you about 3 of the most common RMD mistakes people make so that you can avoid them. Remember, part of any savvy IRA plan is minimizing costly mistakes. 1. Incorrectly aggregating RMDs across different accounts. Tax rules prohibit you from taking an RMD from one type of retirement account to satisfy another, even if the total RMD amount across your accounts seems the same. Each account must fulfill its own RMD obligation. Mixing them up can lead to penalties. 2. Aggregating RMDs between spouses. Each spouse's retirement account is treated individually. Even if you file jointly, you can't combine RMDs from different accounts to simplify withdrawals. Each spouse must take their RMD from their respective accounts to comply with regulations. 3. Forgetting to take an RMD. While it's human to make mistakes, neglecting an RMD can lead to severe consequences. Whether due to distractions or oversight, failing to withdraw the required amount triggers penalties. Ignoring the mistake only worsens the situation, potentially inviting further penalties and interest from the IRS. The key takeaway is vigilance. Stay informed about RMD requirements and ensure compliance to sidestep unnecessary financial setbacks. One strategy to minimize the impact of taxes on your retirement savings is to avoid taking distributions from your IRA for as long as possible. This allows your retirement money to enjoy its favorable tax-deferred status for as long as possible. It also helps to keep income off of your return, which, as you've already learned, not only helps keep your income tax bill lower, but can also help prevent increases in other costs tied to your income. There are some major downsides to this approach, though. Most notably, as your IRA gets bigger, so does your problem. Think about it. If your tax bracket remains about the same over time, then as your IRA grows, so does the amount you're eventually going to have to pay Uncle Sam. This is much different from other things you may be used to. For instance, imagine you buy a house for $200,000 and have a $50,000 mortgage. If the house doubles in value to $400,000, does your mortgage increase to $100,000? No, of course not. You get to reap all the benefits of that appreciation, but that's not the way it works with an IRA, 401k, or similar account. If those accounts double in value, you don't get to keep all the gains. Uncle Sam is entitled to his share. Plus, by waiting to take distributions for as long as possible, your required minimum distributions later on will be larger. This could increase the impact of some of those side effects we've talked about. Thankfully, there's a way to fix this so that, to go back to the mortgage analogy for a moment, you can own your IRA free and clear so that only you benefit from future appreciation. It's called a Roth IRA conversion, and it's our next savvy IRA planning strategy. A Roth IRA conversion is the name given to a special type of transaction where you move money from your pre-tax retirement account, like an IRA, 401k, or 403b, to a Roth IRA. When you make a Roth conversion, the amount of money you convert is added to your tax return for the year and is taxable at whatever income tax bracket you happen to be in. For example, let's say Jill has $100,000 in a traditional IRA and would like to convert it to a Roth IRA. We'll talk more about why she might want to do that in a moment. If Jill moves forward with her $100,000 Roth IRA conversion, she'll have to add $100,000 of income to her tax return for the year, which will be taxable at whatever rate Jill happens to be at. Because this is a big decision and can have a significant impact on your taxes, it's always best to discuss this option with your tax and financial advisors beforehand. So why would you voluntarily choose to make one of these Roth IRA conversions and pay taxes before you have to? Well, there are a lot of reasons, but perhaps the most common reason is one we've already discussed: to pay off Uncle Sam now so that you own your retirement account free and clear for life. Remember, with a Roth IRA, you have the potential for future tax-free withdrawals of everything in your account. If you are over 59 and a half and you've had any Roth IRA for more than 5 years, then all withdrawals from any of your Roth IRAs will be tax and penalty free for life. If you're over 59 and a half but haven't had a Roth IRA for 5 years yet, you can still take out any of your converted amount tax and penalty free at any time. If you're younger than 59 and a half, other rules apply. Something else to keep in mind is that unlike Roth IRA contributions, there are no restrictions on who can make Roth IRA conversions. You can't be too old. You can't be too young. You can be working or you can be retired. There's no minimum amount of income you need or a maximum amount of income you can have. I think you see what I mean. If you want to convert your IRA to a Roth IRA, there's nothing in the tax rules that will stop you from doing so. The potential tax-free nature of the Roth IRA may also provide you with additional benefits, such as a hedge against tax rates rising in the future. When it comes to your retirement, there are a lot of unknowns. What will the market do? What will inflation be like? What will your tax rate be? And so on. That last one, taxes, is a major concern for many retirees and one we've already talked about a bit. A Roth IRA conversion can help manage that risk by paying taxes at today's known rates. If tax rates rise in the future, tax-free distributions from Roth IRAs will be even more valuable. Of course, if you think your tax rate will be lower in retirement, then that would be an indication that maybe this strategy is not right for you. Also, since Roth IRA distributions in retirement are generally tax-free, they typically don't impact the other things tied to your income that we discussed earlier. Another big benefit of the Roth IRA, and one that many retirees find attractive, is that Roth IRAs have no required minimum distributions during your lifetime. Remember all those RMD calculations and potential mistakes we talked about earlier? They're not an issue if you have a Roth IRA. During your lifetime, you can take as much or as little as you want. You're not forced to take anything at 73 if you don't want to. That means your Roth IRA can continue to grow and compound tax-free for your heirs, which also makes it a very intriguing vehicle from an estate planning perspective. The Tax Cuts and Jobs Act, however, eliminates the recharacterization option for conversions made in 2018 and later. If you convert your Roth IRA now or in the future, you are stuck with that decision. Even if your tax bill is higher than you thought, or if the conversion accidentally phased you out of a credit, or if your investments dropped in value, no matter the reason, you cannot recharacterize that conversion. So, with that in mind, it's very important that you are sure you want to convert your Roth IRA before doing so. Here are 3 questions to ask yourself before converting. Do you have a rough idea of the conversion's impact on your tax bill? Do you have a plan to pay the resulting taxes? Do you have a reasonable expectation that the benefits of prepaying your taxes like this make sense in your overall plan? The answer to all these questions should be yes. Here's a savvy conversion strategy that might be helpful for you called filling up the bracket strategy. Remember those tax brackets we looked at earlier? Well, sometimes you can find yourself in the middle of one of them with room to add more income without pushing yourself into one of the higher tax brackets. For example, in 2024, the 22% tax bracket for married couples filing a joint return goes from about $94,000 to about $201,000. Suppose then that you file a joint return and your taxable income is $100,000. That means that you could add another $100,000 of income without going into the next bracket. Making a Roth IRA conversion of that remaining amount could make sense for you. If you plan to convert a sizable portion of your IRA, this approach is often more tax efficient than converting the full amount at one time. Instead, you can make smaller Roth IRA conversions over a number of years, filling up your bracket each time. This can help reduce the average tax rate you'll pay on your converted money and also spreads the tax bill out over a longer period of time. Roth IRA conversions can be especially useful if you had a low income year. For example, are you a business owner with unusually low sales? Or are you paying high, non-recurring medical bills? Or maybe you're retired but not yet receiving Social Security benefits, pensions, or IRA distributions? These are questions to ask to see if a Roth conversion is a good move for you. Of course, these strategies aren't for everyone, as you can see here, and there's no guarantee that a Roth conversion will achieve the intended results. There's a good chance that at some point during your life, you're going to want to move around some of your retirement money. Maybe it will be done as part of a Roth conversion. Maybe it will be to make a new investment, maybe to work with a new advisor. Whatever the reason, you should be aware of how to move retirement money so that you don't make costly mistakes that could derail your retirement. In general, there are 2 ways you can move retirement money. You can either move it indirectly in what's known as a 60-day rollover, or you can move it directly via a direct rollover or trustee-to-trustee transfer. Moving money directly is usually the savvy choice. First, let's take a look at indirect rollovers. In an indirect rollover, you receive a distribution of your retirement funds payable to you, or they are sent to a non-retirement account. Then you have 60 days from the time you receive your distribution to get it back into another retirement account. If you miss the 60-day deadline, the distribution is taxable, and depending on your age, it may be subject to an additional 10% penalty. Even if you're on top of things and you complete your rollover within 60 days, there are other problems with indirect rollovers. For instance, if your withdrawal is coming from an employer-sponsored retirement plan, like a 401k, the plan generally has to withhold 20% of your distribution for income taxes. Congress wants to make sure you don't take your retirement money, run away, and never pay the taxes you owe. A separate troublesome rule applies to 60-day rollovers from IRAs. If you're moving your money to another IRA, only one of these rollovers can be done per year. If you try and make a second 60-day rollover, chances are the entire amount will be taxable. The same rule applies to Roth IRA rollovers. As you can see, there are some real problems with indirect rollovers. Thankfully, there's generally a better way to move your retirement money. In a direct rollover or trustee-to-trustee transfer, your money is sent right from your old retirement account to your new retirement account. There's no 60-day time limit to worry about. There's no mandatory 20% withholding, and there are no one rollover per year rules to be concerned about. Typically, this is done by providing you with a check made payable to your new custodian. For example, the check might read Company X, Custodian, for the benefit of John Smith IRA. If the check is made payable to your new custodian like this, your distribution can still qualify as a direct rollover and get the same favorable tax treatment. There is no 60-day deadline and no mandatory withholding. That's true even if your plan sends you the check and has you forward it to your new custodian. Another essential component of any savvy IRA plan is making sure that you coordinate your IRA planning with your overall retirement, estate, tax, education, and financial plans. Your IRA and other retirement accounts can impact each of these areas, and it's important to factor those things into your planning. Some of you may have all of your savings in retirement accounts, but many of you probably have some of your savings in IRAs, 401ks, and the like, with other savings in non-retirement accounts. If that's the case for you, one savvy strategy you may want to consider is coordinating your IRA with your overall plan and carefully selecting which of your investments are purchased with IRA money and which investments are purchased with non-retirement account money. Doing so could help you meaningfully lower your tax bill. Here's an example of what I mean. Let's imagine that you have $100,000 in an IRA and $100,000 in a non-IRA account. Let's also imagine that you want to purchase $100,000 of bonds with a hypothetical interest rate of 4% and $100,000 of stocks that will pay hypothetical qualified dividends of 4%. Also assume that you plan to live off the income these investments generate and that you're in the 24% tax bracket. In the first scenario, you see all of the stocks are purchased inside the IRA account and generate $4,000 of qualified dividends. In general, qualified dividends receive special tax treatment and are taxed at long-term capital gains rates. These rates are lower than ordinary income tax rates. However, because this investment was made inside an IRA and all withdrawals from an IRA are taxed at ordinary income tax rates, if you take a withdrawal of the $4,000 of qualified dividends, they'll still be taxed at your hypothetical 24% ordinary rate, resulting in a tax bill of $960. In the same scenario, you have $100,000 of bonds that also generate $4,000. Bond interest is taxed as ordinary income too. So that means that you'll owe another $960 of tax on that income, bringing your total tax bill to $1,920. In this second scenario, the bond purchases are made inside an IRA. They generate the same $4,000 of interest as before, and if withdrawn from the IRA, will be taxed at your hypothetical 24% rate. This gives you the same $960 tax bill for your interest as you had before. Now, however, you're purchasing your stocks with non-IRA money, and your qualified dividends are taxed at long-term capital gains rates. If your ordinary income tax bracket is 24%, then you have a 15% rate on long-term capital gains. Now, your tax bill on your qualified dividends drops to $600, bringing your total tax bill to $1,560. That's a $360 difference compared to the first scenario and a tax savings of nearly 25%. In both scenarios, you invested exactly the same amount of money in exactly the same investments, and you took exactly the same investment risk. However, in scenario 2, you get to spend an extra $360 simply because of your savvy planning. So remember, when it comes to your investments, it's not just what you own, but where you own it. Of course, you should be aware that anytime you're dealing with investments, there's no guarantee they're going to perform as expected. And while I don't anticipate the special tax rate for long-term capital gains to be eliminated anytime soon, there's no crystal ball to predict what Congress will do in the future. Another way your IRA planning needs to be coordinated with your overall retirement plan is your Social Security claiming strategy. The decision of when to file for Social Security is one that far too many retirees make without thoroughly evaluating their options first. This is a major mistake, and one that in some cases can cost you more than $100,000 of income over the course of your retirement. Now, the decision of when to claim Social Security is a very personal decision, and one that varies significantly from person to person and couple to couple. That said, many retirement experts today believe that too many people claim Social Security too soon. Remember, Social Security benefits are guaranteed to last your entire lifetime, no matter how long you live, and benefits are generally increased from one year to the next through cost of living adjustments. Additionally, delaying receiving Social Security benefits past what's called your full retirement age, 66 for most of you, can allow you to earn an additional 8% increase in payments each year until you turn 70 through what are known as deferred credits. For these reasons and more, it may be beneficial to claim Social Security benefits later than you initially planned for. But you have to eat in the meantime, right? That might require you to pull money from your IRA in the interim to help cover your current living expenses. Retirees sometimes opt not to do this because they say, what if I die early? I'll have spent my IRA money, which takes away from my heirs, and I'll have gotten little to nothing for it. While that's certainly something to consider, here are 2 reasons you may want to give that approach a second thought. First, a 2012 report from the Center for Retirement Research at Boston College concluded that Social Security is one of the cheapest, if not the cheapest, annuity available. That might sound a little funny. After all, you don't buy Social Security, right? In a way, though, you kind of do. If you use IRA money to hold off on claiming Social Security for, say, a year, that's kind of the price you paid to get the higher benefit. If you compare that price and increased benefit to what you can get from commercial annuity providers, it's almost always cheaper. Another reason it can make sense to draw from your IRA in order to help delay claiming Social Security benefits is that Social Security benefits are generally more tax efficient than IRA withdrawals. Remember, when you take an IRA withdrawal, the entire amount is generally added to your income and taxed at whatever rate you happen to be at. In contrast, Social Security benefits may be anywhere from 15% tax-free all the way up to 100% tax-free. So, the key point for you here is that trading $1 of IRA income on your tax return for $1 of Social Security benefits will almost always leave you with a lower tax bill and more money to spend. All right, time to move on to our next savvy IRA planning strategy, and that's coordinating your IRA planning with your estate plan. In most estate plans, there are really 2 primary goals. First, to make sure that your assets pass to your intended beneficiaries, and secondly, that they are passed to them as efficiently as possible. When it comes to IRAs, 401ks, and other retirement accounts, that's done with one form in particular, the beneficiary form. I really can't emphasize how important this form is, and yet, time and time again, people fail to update these forms after major life events, such as births, deaths, marriages, and divorces. Many times people think that because they've updated their will, everything is taken care of, but that's not so. For example, if you have your ex-wife or ex-husband named on your IRA beneficiary form, but your will has been updated to say all your assets go to your children upon your death, guess who's getting your IRA? That's right, your ex. And I can't tell you how often this happens to people. That's why it's so important to keep updated copies of your beneficiary forms with all your other important estate planning documents. Now that you understand the importance of the beneficiary form, let's talk a little more about IRA beneficiaries. Any person or entity can be an IRA beneficiary, but there are different post-death withdrawal rules depending on the type of beneficiary you select. Broadly speaking, there are 3 main types of IRA beneficiaries after the Secure Act. There are non-designated beneficiaries, and eligible designated beneficiaries. As you can probably guess by looking at this slide, non-designated beneficiaries generally have the worst tax treatment, and eligible designated beneficiaries generally have the most favorable tax treatment. You might be thinking to yourself then, well, shouldn't I just make sure all my beneficiaries are eligible designated beneficiaries then? Unfortunately, in many cases, that's just not possible, at least if you want to make sure that specific people get your life savings. For instance, take a look at the different types of eligible designated beneficiaries there. Certainly, no one is going to hope that their beneficiaries are disabled or chronically ill. And if you don't have minor children now, it's highly unlikely you're going to have one in the future. The trusts you see there are generally only trusts where the only beneficiary is another type of eligible designated beneficiary, such as a disabled person. So that doesn't work, which leaves you with beneficiaries who are not more than 10 years younger than you are, which generally won't apply unless you're leaving your IRA to your siblings or friends and spouses. If you're married, chances are that your spouse is your beneficiary. But when the second death occurs, who will your collective retirement funds be left to? In many cases, it's going to be your adult children who fall into that middle blue category. Let's take a little close look at the rules for post-death distributions for each of these categories of beneficiaries. Let's start with the group of beneficiaries that generally has the most unfavorable treatment: non-designated beneficiaries. This group is comprised of beneficiaries that have no life expectancy and includes beneficiaries such as your estate and charity. As you can see, the rules for how quickly money must be distributed from an inherited account after death depend on how old the owner of the account was when they died. In many cases, that means such beneficiaries must distribute the entire inherited account within 5 years. This can lead to big lumps of income that get taxed at much higher rates than an owner may have paid during their lifetime. Next, we have designated beneficiaries. If you have named children, grandchildren, nieces, nephews, or other similar close family members who are not your spouse as your IRA beneficiary, there's a good chance that they're going to fall into this category of IRA beneficiary. In the past, this group of beneficiaries was able to take advantage of something commonly known as the stretch, which is where distributions from the inherited account could be spread over the individual's life expectancy. This allowed the tax benefits of the retirement account to last for as long as possible and kept taxable income each year to a minimum. Unfortunately, the Secure Act, yes, that same law from 2019 I keep bringing up, eliminated this tax benefit for regular designated beneficiaries. Now, instead, this group of beneficiaries has to distribute the entire inherited IRA by the end of the 10th year after they inherit. This new 10-year rule isn't as bad as the 5-year rule that hits some non-designated beneficiaries, but it's a far cry from the decades that some children, grandchildren, etc. had to spread out distributions before the Secure Act was enacted. Those of you who expect to pass on large retirement accounts to heirs should be particularly mindful of this change, as it might influence planning decisions during your own lifetime, such as how much, if anything, to convert to Roth IRAs. The new 10-year rule, effective for most IRA beneficiaries and plan beneficiaries, began in 2020. Note, exceptions exist for governmental plans, collectively bargained plans, and certain qualified annuities, where the lifetime income option was irrevocably selected prior to 2020. Finally, we get to the brand new type of beneficiary created by the Secure Act: eligible designated beneficiaries. Eligible designated beneficiaries are the only beneficiaries left who are, wait for it, eligible to stretch distributions using the rules that were in place before the Secure Act was passed. As we discussed before, however, it's a pretty limited list and doesn't help the many of you who plan to eventually leave your retirement assets to your adult children or other persons who don't fall into one of the above categories. And this is what it means to stretch IRA distributions. Eligible designated beneficiaries, and only eligible designated beneficiaries, are able to take minimum distributions calculated over their IRS-provided life expectancies. The stretch IRA, then, is just the name that practitioners have given the strategy of a beneficiary taking only the minimum amount out of an inherited IRA each year that's required by law. Doing so helps an eligible designated beneficiary to minimize their income tax and maximize the tax deferral of the inherited account. In contrast, all other beneficiaries typically have to withdraw all inherited IRA money much sooner, as we discussed. One question many boomers ask is whether or not they should leave their IRAs to a trust. Trusts are certainly good at providing post-death control, and if that's a major concern for you, it's certainly something to consider. However, naming a trust as your IRA beneficiary adds considerable complexity to your estate plan. If drafted properly, trusts can be treated as designated beneficiaries and preserve the stretch IRA. All too often, however, they do not meet the specific requirements outlined by the IRS and end up having to follow the less favorable rules for non-designated beneficiaries. Even if drafted properly, trusts come with certain costs, such as the cost to prepare the trust itself, the cost for filing annual trust income tax returns, and accelerated taxation of any IRA withdrawals that are held inside the trust. Ultimately, naming a trust as your IRA beneficiary is a very complicated matter and is something that should be carefully considered and discussed with your full team of advisors, including your tax advisor, your estate planning attorney, and your financial advisor. Many people name their spouse as the beneficiary of their IRA, so let's talk about that for a moment. If your spouse is your sole IRA beneficiary, then he or she will generally have several options after inheriting your IRA. They include choosing to remain a beneficiary of your account, as well as making what is known as a spousal rollover. Let's talk about each of these in a little more detail. As I just mentioned, one option a spouse beneficiary has is completing a spousal rollover. In a spousal rollover, the surviving spouse takes the deceased spouse's IRA and moves it right into their own IRA. A spousal IRA rollover is an irrevocable decision, and once completed, the funds are treated as though they were always in the surviving spouse's IRA. This is generally the best option for spouses who inherit at 5912 or older. Another option available to spouse beneficiaries is remaining as a beneficiary of the inherited account. This is generally the preferred option if a spouse inherits prior to turning 59 and a half, because it allows them to take penalty-free distributions from the inherited account regardless of their age. In contrast, if they were to make a spousal rollover, the money would be treated as their own, and therefore any distributions taken prior to age 59 and a half would generally be assessed a 10% early distribution penalty. If you're a spouse beneficiary and you inherit prior to reaching age 59 and a half, you can remain a beneficiary until you turn 59 and a half, and then, at that time, execute a spousal rollover. In fact, more often than not, that's the best approach. There are other special rules that apply to spouse IRA beneficiaries, so it's always best to consult with a knowledgeable professional. With that, we've come to our last savvy IRA planning strategy. It's one that you should all know, but for whatever reason, people seem to forget. And that's to always do your homework before making any decisions with your IRA, especially when it comes to investments. IRAs are often the target of schemes and scams because, hey, let's face it, that's where a lot of people's savings are. I know it and you know it, but you know who else knows it? That's right, the scammers. In recent years, the SEC has issued alerts warning certain IRA owners that they may be the target of scams. And the IRS has even put out a publication with the title, "The IRS Does Not Approve IRA Investments," in response to many fraudulent promoters claiming that their IRA investments were somehow given the green light by the IRS. At the end of the day, it comes down to the golden rule. If it sounds too good to be true, it probably is. Your IRA may represent a lifetime's worth of work and savings. Don't squander it by making a foolish decision. Well, we've certainly covered a lot of ground today, and you should have plenty of food for thought. As you've probably realized by this point, IRA planning is a lot more complicated than most people realize. Let's face it, deciding what strategies are best for your IRA crosses into just about every area of planning, from tax planning to investment planning to estate planning. Few retirees are aware of just how critical IRA planning is, and even fewer have taken the time to truly evaluate all of the issues and develop a comprehensive solution. Hopefully, we've helped answer some questions for you today, but chances are you still have others. But that's okay. We are here to help answer your important questions, evaluate your current financial picture, and develop a savvy IRA planning strategy that's best for you and your family. If you have any follow-up questions, please do not hesitate to reach out to me directly. Our office number and my email are on the slide. As always, we appreciate your time and hope we answered some questions for you. Tune in next month for the next video in our financial planning webinar series. Thank you.